All right, so here's what I would hope to see in all of your business plans, at least touching on it. Again, it is a month to month for the first year financials, just assumptions. What are we going to do the first few months, and what's that going to look like for the first year? After the first year, you're going to have to give me year one, basically the total of the month, the 12 month, then year two and year three. And then hopefully you can give me what's called a valuation using a methodology called a discounted cash flow valuation based on your performance. So let's get started. So if we look at sales, which is the top line item, net sales, gross sales, whatever you want to call it, in order to get sales for this is January 2025, let's say, and January 2025 is going to have to be pulled out. Let's minimize this. As you can see, I'll be doing some things in Excel that hopefully you guys will learn how to do yourself over time, but it makes it a little bit easier to play with it if you just drag things out. All right, so we need to know in the coffee company how much we're going to sell in the first month we open. And in order to understand that figure, I need to understand what it is we're selling. So we have coffee and we have food, right? So if you think about business day, these are assumptions, by the way. You have to figure out how many stores do I have? I'm assuming you're going to have one store. Let's keep it simple for now. You have one store. How many cups of coffee can you sell in a day? Let's say you can sell 100 cups of coffee in a day. Well, how much are you going to sell a cup of coffee for? Okay. So here's an assumption of 100 cups per day. And you're going to sell a cup of coffee for $6. Cool. And it's 100 cups per day. So how many cups of coffee would that be per week? Are you open 7 days a week or are you open 6 days a week? So I'm going to, just to get your per day, how many cups of coffee you can sell, I'm going to times six. I'm going to do this times 100 cups a day. And that's going to get me $600 per day in coffee, which isn't too much. But so I'm going to take this number and I'm going to times it by 7, right? So now you're making, just makes a little bit of a difference, right? So they're selling $4,200 worth of coffee on a weekly basis. You can see how I walked through that. Those assumptions are very important. So if you're selling $4,200 worth of coffee per week, what I do here, and bear with me as I do, if you're going to do 52 per week, so, and you're going to sell $4,200 per week, you're going to do your annual. Let's do this per year plus this times 52, enter, and then you get your annual, and I'm just going to divide that by 12. So per month plus this divided by 12. So you're going to get $18,200 per month in just coffee sales. That's awesome. But of course, we're missing something here. What are we missing? We're not just selling coffee, right? What else are we selling? So food. Let's just say, let's put food into the equation. So how many sandwiches and salads do you think we're going to be selling per day? So this number is important. Obviously, right now I won't criticize you on it, but what you want to understand is, all right, look at some other uh, numbers from different coffee shops locally. You have to think, okay, how big is my market? What percentage of that market do we think is going to come to our coffee shop? And if you think for a second, if you close your head, you sell 80 sandwiches and salads per day in one store. That means, when do people buy sandwiches and salads? Between what, 11:30 and I don't know, 4 p.m. I don't know if you're open for dinner. So that's a lot of people coming into your store. But I'm just getting you to think like that. You really have to visualize it. But let's stay with 80. So how much is your average sandwich and salad? Okay, so the average would be, let's say it's $12.
12, yeah, 12.
If you want to break it out, you can break it out. But just for simplicity purposes, we'll per cup or per serving. So okay, so then per day is plus this times 80. So now you have $960 worth of sandwiches a day. And then you could really almost take this formula and copy it down. You see what I just did there? Yeah. And you could say that times 7, this did the annual there, as you can see. hopefully times 52. Yep. So that gives you your per month. And then let's say total sales. You can just have a sum here, and then you have your sum here. And what number we're really looking for is this number, is the per month. And if we can just estimate, if we have some assumptions, hey, we're selling coffee and food, and on a regular basis, we're selling about $47,000 worth of revenue a month, it gives you a baseline. So you can break this down if you want to, which I guess we can do for the sake of the example. You put coffee and food. So in January, all I got to do is just equals this right down here, coffee per month, boom, equals food per month, boom. And one of the reasons why I'm tying it to that is, let's say in the future, instead of 100 cups a day, you say, you know what? No, let's do 80 cups a day. And I change it. It changes, if you can see up here, it changed my January sales. So that's why you want to try to tie these projections, because you're not building out your definitive projections. You're building out a spreadsheet that is functional, operative. So that kind of gives you an idea. So let's just go ahead. Those are two big numbers. Thank you for your contribution there. If I want to say to myself, hey, why don't I just try to grow 5% every month? So if you take this number here plus this times 1.05, that is a growth of 5%. So if I just copy that formula over here throughout the year, if I'm just growing 5% every month, which might be kind of aggressive, you know what I mean? Like it looks a little too aggressive, maybe. January to November, or sorry, January to December, you're almost doubling in sales. Does that sound about right? Or is that too aggressive? It's a little bit more conservative at 3%. So I'm just going to copy this formula down here. It's 3%. You're growing a little bit in food as well through December. Boom, there you go. And then you have total sales. Real easy. And then once you have fun with it and play with it, it's from 47,000. You copy that sum over here. Boom. So there's some basis to this. It's not just blind projections. There's some thought of, okay, how big is our store? We only have one store, whatever that looks like. Remember, this is, if you open up another store, you could almost double this. And of course, a big assumption that you have is a growth rate of let's go 0.03%. That's an assumption that you put in there that you sort of have to delineate here. Because if you don't delineate your assumption of 3%, people are going to say, like, how did you grow? Why are you growing in sales? What's the logic behind that? If you can say, hey, we estimate we're going to grow in sales 3% every month, at least you have an answer. Okay, what's next? Sales is a lot of fun, but what do we unfortunately have to incur as a business beyond sales? Also known as, well, there's costs and expenses. Actually, there's actually a difference, but the first one is costs. So it's really what would be considered cost of goods sold, or what we're going to call, for simplicity purposes, variable costs. And I'm going to just put in parentheses COGS, cost of goods sold, because I guess it's important to understand cost of goods sold. So, all right, when we make coffee and when we make food, it costs us something. The more coffee we sell, the more costs we incur, because every cup of coffee has beans, every cup of coffee has direct costs. The styrofoam, things that we can attest specifically to the volume of coffee we sell, is a variable cost. So some of the variable costs, which I just laid out, maybe the team can give me more. Coffee beans, which are also, I'll just put other cereals. And let's say for the food, it would be okay, let's just say we have two variable costs. We have coffee beans and we have ingredients. There's probably more, which it's important to understand that. So if I looked if I went to my trusty ChatGPT thing and I said, what is the typical variable cost per cent for coffee beans? Do this. Types and quantities. So the typical variable cost percentage for coffee beans in a coffee business usually ranges from 15% to 25% of total revenue. So let's take 20% as the goal. I'm just going to put my assumption here. All right, so plus coffee times 0.2, enter. There's my variable cost of coffee beans. Does it make sense? 20% of sales is that. So this, I'm going to do this little thing where I keep it consistent. Let's see if I can do it. Here F4 it should be, no, 3, F3, no, 5, no, F2. This consistent, no, this consistent. I gotta keep that 20% consistent. So I have to take this, I can't type in the 20%. I gotta put it down here. Cost, let's do the variable cost of beans is 0.2 and it's a percentage. So let's get out of this. So I'm gonna do plus this times the 20% here, press enter. And this is just a little trick in here. I'm pretty sure I can do it now. Yeah, so I press F4, it puts dollar signs in front of here so that it just stays consistent. So that when I copy this formula, it stays on the cell down here. So if I go here, it's still pulling from this 20%, doesn't follow it. Makes sense. Little Excel tricks. This isn't an Excel class. All right, so we're building our costs. How about ingredients for food? What is the typical variable cost for food at a coffee shop? Generally ranges from 25 to 35% of the food sales revenue, type of food, offer, quality. So between 25 and 35. So let's do 30. So there's some research there. Variable cost of food is 0.3. All right. So plus sales. Did I do it right there?
Oh, you're doing the coffee.
I go here, right? Okay. Times what?
30%.
30%.
30%.
And then don't forget to put the dollar signs there. Press enter. Gotta format it right. Drag it across. Cool. And so this next item here is called the gross margin. And it's important to know this because you're differentiating between your variable costs, which are tied to sales, and your what we're looking at next is operational costs, which are fixed, more fixed. They're not going to be able to do it as a percentage of sales. You're going to have sort of a flat number that's going to grow over time, or it depends if you can keep your variable costs the same. But let's focus on gross margin. Gross margin is a very important number. It's also known as contribution margin in some sense. It's really contributing to gross margin is very important. If you have a gross margin, you're in business in some way or another. And you can analyze these gross margins. I won't get too complicated, but it's very, very important for any business. If you're in a business right now and you're in any way involved in accounting and they're not tracking their gross margin or their contribution margin, you need to do it because it's really important. It matters. Okay, so let's go. Plus gross margin is going to be, let's total this to do it better. Total variable costs. This auto sum is a great formula. Drag it across. You should really have bolded this because these are the numbers that matter. And then what's the gross margin? Sales minus
Your cost.
total variable cost
Total.
equals gross margin. We're in business, baby. Boom, look at that. Good deal. Good deal. Okay. Now what? We have operating costs. You all have taken an accounting class. I mean, you could call it operating costs, you call it fixed costs, you call it overhead, but usually it's operating costs is perfectly understandable. So we have a coffee place. Are we leasing the coffee place or do we own it? Rent is very important. You know, where are you guys thinking about locating your coffee shop? I'm assuming it's about with in Wynwood. And Wynwood for say 1,200 square feet per month in rent.
Like,
Ooh. For a 1,200 square foot space, this translates to annual rent. So monthly rent ranging from 4,000 to 8,500. So I don't know how much square feet you're trying to have. Do you know? Okay, that's important because the square footage will tie into how many employees you can have, how many coffees you can sell, the square foot, and obviously how much your rent is going to cost. So let's just take the lower range there. Let's just take 4,500. Let's just again, assumption is that we rent 1,200 square feet, and our rent is going to cost us $4,500 per month. You don't really have to put that there because it's going to be here, pretty straightforward. And then if you're signing a lease for a year, is your rent going to change on a monthly basis? So it's the same every single month. Okay, cool. How about your what's this labor would probably be a bad one. Your wages be a better way to put that. How many people are you going to hire to work this store? How much are you going to pay them? Okay, 3 people, we're going to be making $22 an hour on average. That's just, and then how many hours are we going to work? We're obviously working, maybe we do shifts. How many people need to cover the restaurant or the store? One person at a time or 2 people? People 7 days a week. So it's going to be interesting to, 3 people, $22 an hour. You got to have 2 people in the store every time. So let's just do it like that. So are you guys open 8 hours a day or 10 hours a day? What are your hours? You see how some of these questions in the financials, they sort of emerge these decisions that need to be made. So 9 hours per day, and you're open 7 days a week. So it'd be plus this times this is what your one person per day is going to cost you. And then you have 3 people. So it would be plus this, well, 2 people per day times 2. So that's going to be your per day wages, and you're open 7 days a week. So it's going to be plus this times 7. So that's how much it's going to cost you a week in wages. And then, of course, we did the per month. The per year is plus this times 52. And then you do plus this divided by 12 for your monthly. You see, I'm trying to line it up to appear to some degree. Per day, per person. All right, you get the idea. So per month, $12,012. You thought you were making money, but you're getting robbed over here by your staff. You can pay them per cup instead of per hour when I get them working harder. But okay, you get the idea. And then obviously, unless you get a raise, and this is why if you want to change your $22 an hour to $25 an hour, you just come down here, boom, you change it. And now you're even more expensive. If you're like, what are we thinking? We got to pay a minimum wage. You bring it down to $15 an hour, and your wages decrease substantially. You see the impact here. It's very important. So we'll keep it at $22 an hour for now, and we will build this bad boy out to here. See if that works. It doesn't. Something's wrong. So let's just going to be the same, right? Yeah, it's going to be the same. Let's see how you do that. Equals Okay. I think that'll work. And then if you change here, let's go down to 21. Let's see if it changed it. Yeah, it changed it. Okay, good. 22. You see, it's important that you keep the formulas consistent. All right, so let's just say you have insurance as your other. Now, let's not get too complicated. Let's say our insurance costs us, this is general liability, workman's compensation, this kind of stuff. Let's say it costs us $1,000. This is plus this times 1.22, enter. So that this 1.22, just so you know, I won't break it out. That it's basically just because you're paying someone $22 an hour, you're actually paying them 22% more because of, as an employer, you have to pay payroll taxes and sometimes even more, like if you have ADP or whatever. So, or if they have benefits or other things. But thanks for pointing that out. So you're saying this is a legitimate quote, by the way, an insurance quote that you can hold him to. Liability. Was solicited a bid for insurance here. And workers' comp. So you're saying $3,500 a year and $1,200, $3,500 for general liability and $1,200 for workers' comp. Yeah. All right. So this plus this divided by 12 would give our monthly rate. It came out to some bozo cost there. All right, insurance. I was going to say 1,000, be much less, equals this. You can see how I came up with those assumptions. It's obviously going to be the same every month because you're certainly not going to change your insurance quote. It might change every year. They give you new rates. All right, total operating costs. Bold. We have some. Cool. It may look complicated, but it's not. If you just spend some time on the assumptions and you have a general idea and you drag the formulas out, it's pretty straightforward. And then we're going to do a very similar thing for years 2 and 3. Very similar, but slightly different. And we'll be done. We're almost done here. So, all right, total operating costs. So now we're looking at something called operating profit or profit before taxes, essentially. We'll call it operating, we'll just call it profit before tax. How do we calculate that? Gross margin minus total operating cost is profit before taxes. Pretty good. Pretty good deal. But we're not done yet because we have taxes, which we have to at least estimate. So tax is going to be, let's just say it's 27%. Florida might be a little bit less. But let's say our tax is 27% plus, pull this down here. Tax rate 0.27 plus our profit times 0.27. That's great. And what we have to do is, that's a lot of taxes. Might be a little bit less than that, but do is take this, make sure it's the same, drag it across. And now we get our net operating income after tax. Insert. Insert. Pretty good deal. Officially done your income statement for 12 months. That's it. Congratulations. You have done it. And the assumptions are important. Obviously, now that you have this template, you can change those assumptions. Like, for instance, I'm going to look up right now. What is the tax rate on a small business that is doing? Let's see, we don't have a total here, do we? One total. Nope. Sum total here. 600,000 in sales, pretty good. Sum total here, sum total here, sum total here, and the sum total here. $206,000 year one. All right. In Florida. I'm assuming that you're going to be probably an S corp or partnership. Sole proprietor. These entities are generally not subject to federal Florida corporate tax. That profits pass through the owner's personal income. So, yeah, it's your personal income tax, 21%. C corp. Okay. It depends on your personal income tax bracket, but let's say 27% is not a bad estimate. But that's going to be an important one for you to figure out. All right, year one is done, right? Total year one. So all we have to do is take this. Let's see how we can do this. Hopefully you're still tracking with me. Copy this entire thing. Again, each their own in this whole process here. I have my way of doing it in Excel, and you might have a different way. Of course. Copy that. And then I just do paste values, and then I'm just going to take out all of this nonsense, delete. Boom, we have our year one. So we have year one, year two, year three. All right, here's a question for year two and year three. What's going to be your growth rate? Like year over year. So you want to make $250,000 more in sales? Is that what you're saying? So you want to go from like 700 to 950? So that's just, you just try to nail it down to a percent growth rate. Let's say, let's just say it's 30%. I don't know if that's going to be ideal percent. So you just do plus this times 1.3. Let's see if I can do it. Plus this times 1.3 is 30%. So let's see if that equates. 4. All right. Let's see if we can drag that out to year three as well. So you're going to grow another 30% from year two to year three. Is that right? Yeah. Pretty good.
Yeah, for year 2 and 3, yeah, we have projected growth of 20 to 25% annually. Okay. Yeah.
So let's go back to here and let's say this is 0.25 and this changes to 1.25. And that should change your growth rate too. Okay. So what's interesting about this? So now you're operating in years, like year over year. You're obviously to go from year one at 700,000 to 1 million in year three, you're gonna have to add operating costs. You don't obviously need to mess with your variable costs because your variable costs should remain the same. They might even go down slightly because of economies of scale. So if your coffee beans, if you're selling $285,000 in year one worth of coffee and you're at 20%, if you're selling 440, which is almost twice as much coffee in year three, you might be buying in wholesale. You might be buying from a vendor that's willing to compromise and do business with you or negotiate with you where that coffee bean price might go down to 18%. So there's interesting things you can do when you start scaling a company to control your costs. But for now, we'll just keep it as is. We got to sort of put the cost of goods sold again here for coffee. And then cost of goods sold for food, I think was 20 and 30, 0.2 and 0.3. So maybe plus this times coffee. There we go. And then this 4 to this goes here. And I'm going to come here and I'm doing plus food times food cost of goods sold and F4, copy it, format it, clean it up, and then you sum it. Boom. Boom. And then here we're going to do plus this minus this. Pretty good. It's a great margin, actually. It's a great margin. So the margin is going to cover your operating costs and contribute towards your profit. So the more margin you have, the better. I mean, if you have margin in a business, you should be in business. You can always control your operating costs. And obviously, margin is the most important when it comes to saying, if this gross margin was negative, you got a problem. If the more cups of coffee you make, the more money you're losing, that's when you really need to consider some changes in your company. All right, so rent, obviously, you might need to open a new store in year 3. So we might have to double rent here. So we'll just go ahead and put rent at 100,000 this year because, again, it might not be true, but I'm just trying to demonstrate to you what would be the case. And typically, rent year over year increases about 2%, sometimes 3%. Just in most leases, that's how it's negotiated. So it would be plus this times 1.03. So you're probably going to be paying a little bit more rent in year 2 than you were in year 1. And then, of course, you open up a new store in year 3. If that's what happened, the financials will tell a story. Wages might change, but we'll keep them. I mean, they're definitely going to change. Insurance will probably stay the same. And this is going to less. So I just was lazy there on your wages. So you're going to have to figure that out yourself because I don't want to see the same wages year 2 and year 3 as in year 1 because that would mean that you're driving the people really hard. You might have to make 1 or 2 additional hires year 2 because I'm sure you can understand you're increasing sales a lot, you're increasing volume. You should probably hire an intern or something. Okay, plus total operating costs. So it'd be plus gross margin minus total operating costs. And then this would be plus this times 0.27. Plus is just an indication for a formula, by the way. This times, I use plus instead of equals. Those are your taxes. And so profit, that's a lot of tax. Oh boy. Plus this, it's a lot of profit. There you go. Year 1, year 2, year 3. So you got your 12-month, you got your 3-year, and then what's next? Most fascinating part to me is what's next is, again, something that I want you to mess with because it'll give you an idea. If you need to raise money, I think the coffee shop might not be a good example, but if you're looking to raise money, it's really important to do a valuation of your business. And in order to do that, you have to have some idea what your cash flow is. So before you do a valuation, you have to go through the process of what we just did. You probably should do about 5-year projection for evaluation, but we won't do a 5-year projection for evaluation. And you have to calculate your cash flow. And the cash flow here is pretty straightforward. There's no depreciation. There's no amortization. There's no non-cash expenses. There's no accounts, will be accounts payable. No, we're not going to do a balance sheet. So it's real simple. Your cash flow is your profit before taxes. Because all of these are cash items. Most of them should be cash items, unless you have accounts receivable. In the coffee business, I don't think you have accounts receivable, unless you're doing events. But so people pay you for coffee, you get the money. They pay you for food, you get the money. You have to pay your vendors when you pay them for material. It's pretty straightforward. Your rent goes out every month. Your wages go out every other week. Your insurance goes out often. You might have like a prepaid insurance account or something, but we won't mess with that. So really your cash flow is your profit before tax. So this is the cash coming into your business. They don't care about after tax. It's not really an item when you think about valuation, your tax rate and all that kind of stuff, because there's ways they can mess with that at the corporate side. So if I know that year one, $282,000, 409 in year two, and 527 in year three, I can have somewhat. And again, I'm going to put this spreadsheet. I'm not sure if I have the energy to go through another one of your businesses, but I'm happy to set up some time this week with your team to meet if you want to do this with me over Zoom, and I'll ask some questions too, so we can walk through it together. But okay, so here's what evaluation would be. We only have year one, year two, year three. So if you think to yourself in your mind, like, how much do you want to sell this business for at the end? Like when you at the end of year three, you have to have an idea, like a terminal value of what you want to sell this business for. And then you can come up with a present value. So I'm not going to give the nuances of this formula because it's in here, but what's really important is something called a discount rate. You think about the value of money today versus the value of money 3 years from now. The value of money today is more valuable. The discount rate, the weighted average cost of capital right now is about 8%. It takes into consideration a discount rate for inflation and then opportunity cost, risk. A little bit of that is all kind of baked into that. So here's what we would be doing. In year one, your EBITDA, essentially your earnings before interest, taxes, depreciation, amortization, is 282,351. 282,351. 282,351. Cool. Let's take out year two and year three. Let's just put here and nothing here. Okay. And let's say you want to sell the business for 500,000 here. I don't know if that's going to be enough, but just for an example, sort of have to have a number there in the terminal value. Okay. All right. So what does this number mean? Discount factor. So year zero is today. A year from now, you're going to be making 282,000. So it's not, you don't have $282,000 today. Technically, you made that profit in 12 months from now. So you have to discount that back. And here's the discount factor based on the weighted average cost of capital. It's a funky formula. Just trust me, it works. It takes into consideration time. It takes into consideration the discount factor. Those are really the two variables you need. It's 1 divided by 1 plus the time to the power of the discount factor. So, and then that formula is copied over here. It's copied over here. It's copied over here, but you don't really need it. So what's the present value of $282,000 today that we're going to get a year from now? It's really 261. What's the present value of 324? I don't think we have in there, correct? It's 409,954. 409,954. And then 527,111. 527,111. Okay, cool. And then 500,000. So really you're just looking here. And when you're looking there, this right here is just adding all of that up. And what this is doing is it's taking that discount factor. Okay, cool. Wonder where this is going to come into play. It's not. So I need to do that terminal value, present value, terminal value. Okay, so 500, 1, 2, 3. That there. So I have to discount that present value back by 3 years. Let's see. Here it is. Okay, cool. All right, 340. 340. So we gotta move this over here. We gotta move this over here. 396. And then this venture value has to include that as well. Oh, look at you. Okay. So that's what I did. It's called a discounted cash flow method. If you just use the formula that I have in there, if you want, you can come up with a tentative present value of your venture. And why is this important? If I say, hey, listen, I'm going to invest $500,000 in this business, and I believe that this business is going to make, it's going to cash flow 261 year one. It's going to cash flow 351 year two. It's going to cash flow 418 year three. I need to make sure that my $500,000 is worth how much of this company. If I'm going to put $500,000 in, how am I going to determine how much money I'm going to own of this business? Well, here's the answer. If the venture is worth, we believe it's worth 1.4. If everything works out the way it works out, my 500,000 would be worth about 33% of this company. So if you think about Shark Tank for a second, and you say a person goes to Shark Tank and they say, all right, listen, I'm going to build this coffee shop, and I know this coffee shop is going to work, and we'd like to offer you a chance to invest. we're giving you an investment position of say 20% in our company. And for that investment position of 20%, we need $400,000 of money. And so that's like roughly 20%, 400,000. Okay, fair enough. And the guy comes back to you and says, "Are you kidding me? I'm not going to give you 400,000 for 20%. I want 50% of your business, and I'll give you 200,000." And so you know that if the work works out the way you want it to work out, if you gave him 50% for 200,000, your business now is worth $400,000. He just discounted the value of your business by almost $1 million in just one comment right there. So that's why it's important for you to know before you try to raise money, before you go to market and see if you want to sell equity in your business. You have to understand, well, how much money am I going to make, and how much cash flow do I have, and like I'm not just going to give away my business. I need to know this information. So hopefully that makes sense, and hopefully that's why when we talk about business plans and we talk about our capstone project, doing these financial projections are important, and having this language when it comes to raising money is vital. And even angel investors, not just venture capitalists or other people, just anyone. If anyone gives you money, they have to understand how much that money's worth of ownership in your business, unless they're just giving you a present for your birthday, which doesn't normally happen. In which case, that's your money and it's your equity. You don't need to raise money. That's the ideal case. Okay, I probably don't have enough energy to do this for another company, but I want to ask if you guys have any questions or if you found this valuable.